Uh, but Marty and I have been fascinated with the whole evolution of ESG and kind of the overemphasis on renewables, we can say now in with 2020 hindsight, or at least the market's getting ahead of them and the difficulties. And we have a star-studded panel. We have two people who need to speak quickly, Victor Sauers and then Kylie Fox. Kylie is in Dubai right now, but Victor actually is up against a board meeting. So I've said Victor can speak first, then Kylie, and then we'll have Bate speak, and then last Nick Rohleder, and I'll introduce them first. But Victor, we spoke earlier today, and we've spoken several times between conferences. Tell us what's on your mind in terms of the energy transition.
No, good. I'm glad we changed the title because it encompasses ESG, but the bigger point is how capital is being deployed. So when we talk about energy transition, let's look at a high level. What is the cost? It's 10 trillion a year that the world spends on energy, any and all energy. So now we're talking about a transition about what? So clearly we talk about what comes to people's mind of renewables and things of this nature. So on the renewable side, from 22 to 23, you're talking about 22 was about 1.4 trillion investment. And then 2023, we're looking at $1.7 trillion. And that's just on the renewable side, the energy efficient side, things of this nature. But on the same token, as we're seeing an increase of fossil fuel, positive plus $1 trillion per year. Also, we see oil demand increasing, and we also see emissions increasing. We have the really good stuff, the clean stuff that is our renewables. But the same token, if I'm talking about some of our major players in coal, like China, I have 400 coal plants in queue that are going to be built, that will be built. At the same token, China's the biggest renewable player, right? So what do we have going on in energy transition? And we have 8 billion people in this civilization we call Earth. We have 5.5 billion people that are becoming first world consumers, like the US. Everybody wants to be a first nation consumer. Well, there's 5.5 billion people waiting in line that are becoming that. So we do need the energy transition because there's not enough fuel to support that consumption rate. It's just not, period. Anybody in this space that we work with, and I do apologize, I have to cut my time short because this is an hour conversation, because right now I'm in a board meeting with utilities to talk about energy transition and the grid, real time. So when we look at those kind of opportunities, what does it look like as years go by between the US, the EU, and the Asian market going forward? And where's the plays going on? Is it sustainable? Is EV sustainable? Is renewable sustainable? The answer is no. It's in conjunction thereof of our fossil fuels and our renewables and how we're electrifying the world. So when you're looking at what does fossil fuels do, I always tell my renewable friends that understand what fossil fuels deploy other than just energy and where they come up short. I love to do generation in the US and the EU. Obviously, with the Ukraine war, they had to do LNG to be able to supplement their gas. But the issue is that what China's seeing, what US is seeing, there's not enough water to accommodate thermal generation. You need water to create steam, regardless if it's nuclear, gas, or coal. You don't go anywhere, right? China knows that. That's why they're doing coal where they can, where they have water, and that's very low volume per cap that they have. But they also need renewables. US the same way. One of the biggest loads per state is Texas. Texas is a 92 gigawatt load. That's huge. New Mexico is a 9 gigawatt load. So it takes 21 states to match Texas. And guess what? They need water. You want more thermal generation, you need water. What do? You do renewables. And Texas is the biggest renewable state, even though it's an oil and gas state in the country. So you're talking about between investments that in the US, we got like something 400 billion in play. Renewables is taking a lot of that. Energy storage is picking up pace. That's great, but we need infrastructure such as wire, grid. Right now, based on the queue that we have, which is a little over 1 terawatt of backlog, it would take me 30 years to reduce the backlog just constructing renewables. And the reason is I don't have enough wire. We're not investing in the overhead grid infrastructure. So there's going to come a point of inflection that when does microgrids or small nuclear power plants coming into play, right? That's going to be very, very important. Because if I'm spending so much on wire to run wire all over the country, well, what do I do distribution generation instead? Right? Is it renewable? Is it batteries? Is it modular nuclear power plants? Maybe all the above. But wire and infrastructure is very expensive, and we don't have the material in play where we need what we call electrical stainless steel, which is right now about 14,000 tons a year. That builds transformers, that builds EV motors, that builds charging stations. You need that kind of. We're projected to do in the next 10 years 900,000 metric tons of electrical grade stainless steel. In other words, there's not enough mills to supply the demand to be able to handle this energy transition, and that's just one type. So you might hear about lithium and cobalt and other types of rare earth materials. And everything that you would read online, everybody, you would not hear the issue of electrical grade steel. Interesting. The biggest block is not shown or discussed. But the same token, on the way going forward to the energy transition, the gold standard should be thou shalt not harm the working poor. Everybody on this panel and listening to my voice right now can afford double price on energy. Well, the working poor middle class can't, especially after the 21 inflation to 23, because real inflation, living wage in the US has grown 28%, right? So if I do too much renewable penetration, the cost for the ratepayer goes up. Renewable is a fuel mitigator because we need the breathing room to be able to do this transition. So renewables gives me time to be able to handle the type of prosperity we've come accustomed to decade over decade. So those are the kind of things to look at. There's a huge amount of opportunity in many of those sectors that is more than just the electrical generation sector. It's also the consumer. It's also in food. 25% of raw natural gas is used to do 50% of the world's food.
2 minutes.
You lose natural gas, you lose food, right? So who's going to feed the other 4 billion people? There are answers. They're just more expensive. Once again, are you going to harm the working poor? Are you going to harm the middle class?
Victor.
Yes.
Victor, stop. You're too good. The audience already has questions for you.
Victor, could you talk a little bit about Texas, ERCOT, 90, whatever, X power generation? I'm investing in flare gas mitigation and peaker plants. So could you talk about the uniqueness of Texas as a energy market grid, whatever?
Did you hear that, Victor?
So you're talking about investing in peaker plants in the marketplace?
Yes.
Okay,
Yeah, I'm
so
investing in flare
is
gas
this in the
mitigation.
U.S. market?
Say it again.
U.S. market?
Yes, I'm wondering, I'm investing in flare gas mitigation, turning it into electricity to power data centers, and having the data centers become a peaker plant to ERCOT. But I want to do it on the periphery of Texas, in Oklahoma and in New Mexico, in the northwest Texas. So could you talk a little bit about the uniqueness of Texas as an energy market, please?
All right, so if you're a load and you act like a peaker, what you're saying is that you want to play load as a resource, right? Basically, you power down to a degree, right? So you add capacity on the ERCOT market, and that's called LARS, everybody. That is much better than demand response because you pay market pricing. So my market price demand.
Victor, did we lose you? Or you answered, you finished the
A little
question?
background noise, Marty.
We just opened the door, sorry, there's a lot of people here.
Marty,
Keep on going.
Marty, if we could get the name of the questioner, Victor will catch up with him offline. That's rather technical. And I'd like
Okay,
to
great.
move forward.
Yes, okay, great.
Yeah, I'd be glad to.
Okay.
Thank you, Tyson.
Thank
So-
you, Victor. Our next very talented speaker is Kylie Fox of KRF Capital. She's working on multiple projects, and she's going to describe some of those: variable diesel, floating, solar. I think she said plasmatic explosives for mining. Tell us what you're doing and what you're doing in Dubai, and tell us how the hotel is.
Fantastic. I mean, everything is actually quite interesting out here. There's obviously a lot of momentum and interest in it. Basically all of the world is kind of gathered here for COP28. We're also here with an investment that we did on the sporting side that's completely environmentally friendly with SailGP, who runs on SAF fuel. So our approach has been to invest in companies that have proven technology with at least the pilot side, and then we team up with them to make them financeable. And we have joint ventures with development companies, both in the US and Canada and Europe. We invest in companies from an IP perspective, both US, South America, Europe, and starting to look more in the Middle East. So it's basically quite exciting here. We've been investing across the renewable space for quite a bit. We've been growing our platform across the renewable diesel side, hydro turbines, hydrogen, SAF fuel, and coming up with solutions that are having the least amount of footprint from a carbon side and creating efficiencies. So similar to what our previous speaker said, we think the demand of energy is growing exponentially. There's a lot of inefficiencies even within the great momentum that's been building across the renewable space. And so we feel like we're trying to do it the most efficiently as possible. We do waste to energy, which combines biomass and plastics. We also do tire recycling to energy. So we're looking to really complete that closed loop production of energy. So we can do it for residential communities, we can do it for industrials, and we can do it for direct to consumer. We're always looking for new innovation that mitigates the footprint that you have even on the mining side, whether it's to produce the solar panels. And so really just finding solutions. I mean, we are very appreciative of the momentum that certain governments are pushing forward. We feel like there's a lot of inconsistencies and targets that create different adverse effects that don't necessarily create the full scale solutions. But obviously, you need to start somewhere. So we're just looking to be very pragmatic in our investment approach, finding best-in-class technologies that are ready to scale and grow, and we leverage our ability to access the capital markets and the investor base in order to invest in the companies and also get access to the debt capital, the CapEx. And then we also produce strong returns for our investors. So minimum underwriting that we do is 25%, and that excludes the profitability that we can attain through tax incentives, grants, and also some of the byproducts that are produced when we produce different types of energy. So hydrogen, we can produce grade 5 oxygen that we can sell to hospitals. It also produces iodine. When we're doing renewable diesel, we're creating also byproducts in the biochar and graphene space. There's new technologies in the plasmatic region where instead of using dynamite or other types of explosives, we actually are producing clean, almost like laser-like high thermal energy in order to create the explosives for mining purposes. And also, thermal energy that is a great way of storing solar energy and producing the type of energy that companies like, Google and data centers are using in order to be 100% green and sustainable. So we're very much inspired by the type of constant innovation that's out there, and we do our best to support those companies and bring them the capital, bring them the operators, bring them the engineers, bring them the EPC, bring them the insurance companies in order to make these projects financeable across the globe. That's
perfect. You have 4 minutes left. Can you pitch us your most compelling idea right now?
I'm a big fan of our company that produces both the waste to energy and the hydrogen, because with those type of solutions, you're 100% green. So you're using biomass, you're using plastics, and then you're producing the hydrogen. And these are sort of your back-to-back type of solutions that is 100% green. We're also working with traditional fossil fuel companies like Energia in Canada, who want to layer in a natural gas feedstock, but then we turn it into hydrogen and able to power up 150 of their large-scale industrial clients. I'm out here in the Middle East because it's very much a place of capital and innovation. They're very dedicated actually on the renewable space. And we just believe that, continually to partner up with people, it does take a bit of a village in order to get these large scale projects done. And we're also, teaming up with insurance companies, again, to make these projects financeable. So we're a very pragmatic, focused firm. We also have strong returns, and that's what we focus on. And we're very knee deep in all this stuff and getting the projects done.
Thank you. Marty, do you have any questions for Kylie or anybody in the audience? And then we'll go to Bate.
Any questions for Kylie? My question is, how big is the fund you're raising right now?
We're raising a 250 growth equity fund. And the reason why we focus on the growth equity, because it's the hardest capital to raise. So we find that when we're raising the growth equity for our various projects, it's really the toughest capital to raise. So in order to mitigate the delay and hold up in getting that, because that capital basically finances the engineering and the plant equipment build out. And then once you get into breaking ground and constructing, then the whole universe of the capital markets opens up to you. So what we've done was we built up a pipeline of the technology companies that we invest in. And then we also have over a 15 billion pipeline. But in order for us to get to the 50 billion pipeline, we need that growth equity. And so in order to facilitate that, we've been able to solve for the problem of the blind pool. So we show the companies, we show the pipeline, so people are able to underwrite a whole portfolio of both topco and also portfolio level investment. And then that will able to facilitate us to really unlock and unleash a very large portfolio of renewable energy across the globe.
And this is a fund one?
This is a fun one, but the way that we're mitigating it, having been in private equity for a good chunk of my life, I understand how hard it is to fundraise. I understand, in terms of in the renewable space, this is new thing. So there's not going to be a track record of I've built 20 different hydrogen plants. So in order to mitigate that, what we've done is we've actually done the underwriting, and we can show exactly where we're putting the 250 at fundraise. So they can underwrite each company, they can have the ease of the LPGP structure, but they don't have to go into a blind pool because they can look at it deal by deal and project by project, and then basically be able to commit to something that they know what the rollout is.
And these projects have all been special purpose vehicles today?
Yeah, so today we've just been doing more deal by deal investment, but it's a bit clunky, and so we just want to be more efficient in the scalability because we have the pipeline and we want to execute, and this will facilitate us getting through the hardest bit of the life cycle of these projects and the companies, and getting them to be able to scale and grow very efficiently and make a big impact, and also get access to all those offtake contracts that are 15-20 years.
Well, so what percent are growth capital versus alternative energy infrastructure?
It's just more the capital that you need to get these projects up and running. It's that early stage of the project capital that will allow these companies, because a lot of times we already
So
have
it's
about
like- it's
2
like
different
bridge financing?
LOIs. What's that?
It's like bridge financing?
It's really development, it's development equity, but it's for companies that have proven technology. So we're not doing venture. We're doing companies that have already have proven technology that have been underwritten by companies like
Sure,
New Energy
sure.
Risk. Yeah, so we've mitigated
So
the
what's your target
technology risk.
IRR? What's the target IRR?
Our minimum IRRs of all the deals that we have in our fund pipeline is 25%, and that excludes, again, the tax incentives, grants, and the byproduct sales. So sometimes you're going up to 50, 60%. In some different types of products like SAF fuel, you're going up to 80, 90. So they're extremely profitable deals. And these are with high rated off takers. So really the key is to kind of get over that growth equity stage. And then once you get through that, the returns are outstanding for the risk that's there. And we can get a number of insurance products that will mitigate cash flow risk and also tech risk.
That sounds like a very smart.
Off takers. Tyson, hold on. The majority of your projects have off takers, and I know you mentioned them already.
Our philosophy is start with the offtake and work your way
Of
back.
course. Smart.
So,
We have
yes.
another question. for the
I mean,
audience.
as a banker, start with the secure cash flow security, and then you figure it out. And that's why we work with developers, because we have a strong pipeline. We have connectivity with strong off takers. So we work with, companies like Energia. We work with Toyota. We're working with, LA Water Power Department. We're working with, municipalities, industrial rated entities.
Kylie, I know you're a long time, I know you know your stuff, so got another question.
I worked in the space actually a while ago, working in a company doing biodiesel fuel development. At that time, we weren't able to look at venture. We were looking at project finance. Can you talk about that? What will that maybe change in the next decade?
Project finance and biodiesel?
So we will arrange the project finance. So that the project finance, I have a securitization project finance like that background. So we can arrange the project finance, but in order for us to even get to the project finance, to get that type of capital, whether it's from the DOE, whether it's from a bank, or whether it's from a private lender, we need to get through the growth equity stage, because the lenders don't come in at that stage unless you can get your opportunistic bridge capital. So we definitely layer in the project finance or the tax equity investors or the USD loans, but that typically is usually within an 18 to 12 month period of 2 operations. And so sometimes these projects can take longer than 12 months or 18 months. They can take 2 years, they can take 3 years. The methanol plant is a 3.5 year development phase. So it's just, it's that type of timing, but we definitely are working with project finance providers, both from a public point of view, from a grant point of view, and from a private point of view.
Thank you, Kylie. That's great. I'm going to move on now to Bate, and he's going to talk about. Thank you. That was brilliant. Bate, tell us what you're seeing on a higher level, and give a brief intro, because I'll probably butcher it.
No worries. Good to see you again, Tyson. Hey, Marty. So it's good to be here. Thank you guys for having me. I guess maybe I'll start with who we are. I'm the managing partner at EP Valuation, and we do asset valuations, due diligence, and ESG reviews, or increasingly energy transition advisory. We provide that service to banks, sponsors, and operating partners in the energy space. We think of the work we do as empowering our clients to make more efficient decisions in what is increasingly a challenging energy landscape. Now, we are based in Houston and Dallas, but our clients and the projects they fund are all over the United States. Over the summer, we did some stuff international, but I'll get to that here in a second. So quick background, I'm a licensed professional engineer, bachelor's of engineering from Montana Tech, and MBA from UT Dallas, 22 plus years in this space. I started out with Schlumberger in the field, and then after grad school, joined a small company called Remington Oil and Gas. And I was part of the core team that built that company from a few assets to a $1.4 billion company, and sold it to Helix Energy Solutions Group. Following that success, I moved over to the financial side and worked for MUFG Union Bank for several years, and then ING Bank. At ING, I was head of technical services. And so it was part of my responsibility to oversee the bank's valuation of its $4 billion energy portfolio. Now, since coming to EP Valuation a few years ago, we have done, I would say in the post-COVID surge, nearly 200 valuations on deals ranging from 25 million to 5 billion in transaction value. ESG and energy transition are a growing part of our practice, in part because we deal with players on the ground, right? We deal with companies seeking funding, we deal with companies acquiring other companies, changing operations, improving assets, and we assist banks to understand what's happening and to fund it and risk it appropriately. Having said that, Tyson, I think I'm going to touch quickly just on where Victor left off, which is the confluence of both the traditional energy and renewables, right? So we tend to think in terms of pendulums. So if it's all renewables, it's all renewables, right? Or it's all oil and gas, as opposed to the more middle where you need both renewables and oil and gas. Previously, I thought we could replace oil and gas, if you would, with renewables. Now I know for a fact we cannot. And that's not to say renewables are not important. It is to say that there's pent-up demand around the world and in the US, such that oil and gas alone cannot meet, much less renewable alone. But I spent time in Cote d'Ivoire and Ghana over the summer, and I have to tell you, both of those countries are growing. I mean, there's an amount of energy and growth and economic explosion happening that needs to be supported by new energy sources. They need all the oil and gas they can get, plus renewables, right? One of my colleagues and very close friend in Ghana runs 80% of his electric load on solar, right? Now in the US, to do that requires a whole lot of solar panels just because of the level of energy requirement in the US, right? But more important than that, there's not enough battery storage to run I'd say 3-ton AC. So what you need solar plus battery storage, and most likely, a standby generator to recharge your battery storage when that runs out. My point here is this, that oil and gas is certainly needed, so is solar, and so is renewable fuels, but we need them together. We need to stop thinking in terms of silos. Now, in the aviation space, a lot of that is beginning to happen in the aviation space. We know, for example, as Kylie just mentioned, sustainable aviation fuels are the big thing now, right? And why are they? Because 80% lower carbon, high density fuel, and increasingly reliable fuel. Virgin Atlantic, for example, over the last month, did the first transatlantic flight on 100% SAF fuel. There are companies in the US, for example, Neste, Gevo, and 12 that are cracking the code on renewable fuels, sustainable aviation fuel. That's important because to take out or replace the fuel system, I think it's a little noisy. I can't really hear.
Marty, can we get some of that background noise lowered? I think Bate.
Tyson stepped out of the room for a minute, he'll be back in, but I think when
that's
that
fine.
door swings open, you pick up a lot. And there's not much that can be done to stop that.
All right, that's fine. Anyway, so my point, I was going to talk about the three companies that are, in a sense, leading this charge towards sustainable aviation fuels. That's Gevo out of Colorado, 12 out of California, and Neste, which is a Finnish company that increasingly does a lot of work in the US. These three companies and others produce jet fuel with 80% lower carbon. So they're not replacing engines, they're not replacing traditional oil and gas, they're simply supplementing it. Over the past, I'd say 12 years or so, since 2011, when the first commercial flight based on SAF fuel took place, there has been 50 other airlines that have done the same thing, right? FedEx just announced it will be buying about 800 million liters of SAF fuel over the next 5 years. These are big numbers, but in terms of commercial aviation fuel, that's just 1%, right? All of the pledges for SAF come up to about 1% of jet fuel. So there's a large market for renewables to take on, but there's also a long way before renewables take on oil and gas. So what we need to be thinking about is how do we integrate more effectively oil and gas production and operations with renewables technology. And because to replace technology, you need three things. You need a new breakthrough in technology, you need funding, right? And you need a ready market. Now think about 15 years ago in 2008, during the financial crash, and what happened afterwards. Banks subsequently stopped lending to coal companies as they had before. The Barnett Shale coal was finally cracked, so we had technology change, and we had a ready market for those products. And as a result, coal is at a 15-year low in usage in the US. So I'll send back to you. I'm happy to answer questions, but I think that's really at a high level what we're seeing with the clients we're working with.
Bate, thank you very much. The background
Tyson,
noise
can we
caused
ask
they
questions?
open doors to
Tyson,
a larger
Tyson.
room. Go ahead, Marty.
Hey, Tyson,
Go
are
ahead,
there any
Marty.
questions for Bate? You?
I don't.
Bate,
Go ahead.
what do you think the curve is for renewables in terms of growth? Because you were talking about growth in renewables.
Is that for me?
That's for you, Bate.
Yes. Okay. Well, I think I think over the next, before I answer, let me give you a different example before I answer that. So in 1973, Bell Labs came up with the first solar panel, right? And they produced the first kilowatt hour of electricity, and it cost them $100. And the idea was, well, in about 10 years, will all be solar. That did not happen. But what has happened is that since then, the 30 plus 40 years since then, there's been sustained interest and research. And solar panels now are 1,000 times more effective, but also 99% cheaper to produce electricity from. The curve for renewables is not 10 years. It's more like 40, 50 years. Just because penetration and demand require scalability. Jibo, for example, can produce jet fuel for American Airlines using biomass, which is corn in Colorado. But to do that at a level that will produce, say, 10% of jet fuel nationwide will require an enormous amount of land that cannot be cultivated overnight. So the tech is there, the know-how is there, scaling it is the challenge. And so that's my point. It's about 50 years to get that level of penetration that oil and gas currently has on the market.
So you say there's time for scaling. Got it. Okay, perfect. Nicholaus? Tyson?
Okay, so now we have Nicholaus Rohleder, who very smart guy. He's an adjunct professor both at UPenn in Columbia. He is the co-founder of Climate Commodities, which is a platform company that operates in the physical trading, mineral processing and refining, transportation, logistics, renewable power, insurance, and financial services. He was one of these 30 under 30 people. And Nick, tell us what you're seeing in the energy transition and what you're working on that the people here would find interesting.
Yeah, absolutely. Well, one, thank you for having me. And two, I'll kind of start with my background. I'll kind of go into what our company does and what we're currently working on. And so myself, I'm registered from Oklahoma. I grew up in a family that ran an integrated oil and gas company for a little under 70 years in that part of the country. Started off with a small midstream business, grew it into fully baked midstream plus production plus operating a couple refineries, and had a coal business for a long time. And so I grew up around energy dinner table. My whole family was in that business, and kind of worked every summer. Last thing you want to do, you're a kid in Oklahoma, work construction jobs at a series of their businesses. And so I kind of saw everything they did on the traditional energy side, all the way down to their investments in operating companies in the metals and mining side of this as well. Caught the bug for alternative energy. As a part of that, I ended up going to school for it. So did the environmental finance and science program at Columbia, got master's degrees from UPenn and Oxford, all on the areas of finance engineering. And I've been in this space, for a little over 12 years now. And so, we set up Climate Commodities in 2019. Most of us come from Millennium Management, Castle and Commodities, and Generate Capital is kind of where the bulk of our team is derived from. People hopping from the private equity hedge fund side over to the operating side. And we've set up a number of businesses in this sector. We segregate our business into two areas. The producer services, and then production. And so on the services side, we operate an insurance intermediary business that focuses on counterparty credit risk, on technology performance risk. We operate as well a physical trading desk that focuses on both the intermediary marketing services and then principal offtake solutions, and then selected investments in some of these businesses that are our counterparties. And so very similar to what was discussed earlier, in that vein, we've increasingly started making investments on a pre-FID basis in businesses that either have de minimis technology risk or have a proven technology that have their first commercial project, or they're in a position where they have a development capital gap. On the production side, we own and operate a critical minerals processing and refining business that is focused primarily on the refractory minerals value chain, and then the battery the minerals value chain. And then our last piece of this, we own and operate a renewable power business that's done about 180 solar projects throughout the United States. And so I think that our view has very much been, if we can make money, just similar to the oil and gas side, if we can make money trading it, if we can make money insuring it, we'll integrate into the production side. And so we've taken those steps to become fully integrated within the critical minerals value chain, specific to areas I mentioned in the renewable power value chain. I think that just in general, how this sector is developing, outside of this, we do have the family office as well, and we've made investments in and around this sector for the better part of a decade. We've done hydrogen. I think that is an interesting area where the end market is not fully developed, but there is substantial potential in heavy duty transportation application. Similarly, we've done financial services in this space. It's interesting because as government policy has evolved, it is somewhat challenging to tell the capital gaps in the sector moving around, and you have 8 to 10 year horizons in a lot of these investments versus 3 to 5 year. And then outside of that, we really have looked at just the picks and shovels of this business, and that's what led us to the critical minerals area. And I think as this develops, my side gig is I teach the climate tech finance class as an adjunct to UPenn. And I think it's interesting is when you really take this space and dissect it, you have the electron side of the house and the molecule side of the house, with the electron side of this being solar, renewable power, general electrification, the electric vehicle fleet, which is growing rapidly. And in some cases, the power cost is at parity. You have parity cost as far as total cost of ownership of vehicles, and you have a rapid scaling mechanism with an underdeveloped critical mineral supply. And so we looked at that as, okay, so these projects in the solar space, solar plus storage, operate on long-term fixed contracts. That made a lot of sense to get into from a business perspective, is it's very, very similar to some of the projects that we've worked on in the coal space, right? Contracts work the same. The mechanism for producing energy is different, but the risk profile, from a revenue contract perspective, is somewhat similar. And we looked at it as, what are really the picks and shovels of that business, right? Critical minerals. So refractory minerals, high heat applications underpinning the steel industry, underpinning infrastructure supercycle, and the battery mineral space, they're directly underpinning the hardware in these technologies and in the electric vehicle fleet. And so that was how we got with the macro, and then how we addressed the smart styling of our businesses in the sector. You go to the molecule side. So you have your alternative fuel has been discussed prior, SAF, hydrogen, waste of fuel, so on and so forth. Can insert genre here within that. That is directly operating in parallel to the oil and gas, and then downstream chemicals value chain. In that space, we've invested in one large project that is nearing the FID, and then a series of, when you look at a solar project, the cost level that you incur before you can access project finance is dramatically lower. Say, for example, a blue hydrogen facility that takes in natural gas, transforms it through a steam methane reformer with a carbon capture attachment, spits out hydrogen. You have a much longer development cycle and a lot of costs that the developer is responsible for, where there's not an established capital market to provide those on an economically reasonable basis. To that, Tyson, I know time is, but that's kind of our business and how we view the space. Happy to take questions and delve into any areas of that further.
Marty?
Are there any questions here in the audience? I don't see anybody right now, but again, my issue goes back to what Bate was talking about with respect to capacity and being able to build out all this infrastructure that's needed to do this. And then on the other hand, so the United States is really terrible at maintaining infrastructure. So we're losing hydropower all around the country. So you guys know the statistic on the hydropower in California. California's lost more hydropower than it's gained in renewable energy in the last 20 years. So the issue is how quickly you can ramp up, right? So maybe you guys have some commentary on that. On Nicholaus.
Well, I think that the hydropower situation is pretty interesting. We invested in an agricultural commodities handling terminal that's taken the other side of that trade, with it structurally declining the water availability in regions like California. So it's actually a whole interesting conversation to have there on why that's happening. The counterbalancing plays and the economics there. But I think that on the capacity side, there's two parts to this. One, as I mentioned earlier, and this is mentioned prior in this panel, is that there is a transmission capacity issue, and there's also a regulatory reform issue surrounding the rollout of mass renewable power. And so that's something that it is not a technology issue. It is a pure regulatory and scaling of basic infrastructure, largely those built during the public works period issue. I think that asking a question.
There was just somebody opened the door. There's people in the hallway.
Well, I think my point there is, if this is going to happen, there has to be a well-established capital market and system to address, as someone mentioned prior, the pre-project finance capital needs, and then some of these services around this, like getting an offtake, doing merchant power facilities, getting insurance wraps in and around these facilities. So, for example, with a newer conversion technology, how do you backstop the performance with the insurance, right? So you transfer that risk from the capital market to the insurance markets, so that risk now bears a credit rating from an insurer, right, versus the technology company itself, the hardware company. And so I think the big thing there is that the stage is really set properly. The issue comes down to having an appropriate service ecosystem to de-risk these rapidly and get them out the door.
Sure. It seems like, I don't know if you guys follow, what happened in Oregon, where they're kind of outlawing hydropower and because of salmon or whatever. And I think they're doing the same thing in Washington State. But it seems like there's a pretty much a stampede to nuclear because it's clean energy, right? And so So it's very interesting. My perspective is, again, this country is terrible at infrastructure. You know, I spend a lot of time in New York. They haven't built a new highway in New York in 50 years. In Florida, they built, I don't know, 10 lanes of hundreds of miles of highway, right? So depending on where you are in the country, it's very tough to get great infrastructure. And the places that are looking for this new infrastructure are the places that are the worst at maintaining infrastructure. So anyway, great job, Tyson.
Thank you,
Fantastic
Nicholaus.
panel.
Bate, Marty, always doing a great job. Thank you.
Thank you, guys.
And Tyson, now you're in Charleston.
I'm in
South Carolina.
Charleston, that's correct.
Can you guys do me a favor and put all of your contact information in the chat so people can contact you or online?
Absolutely.
And that will go out, the brochure goes out to everybody, so they'll be able to contact you too. But this is just more immediate, so. All right, great job. Thanks so much, guys.